Okay, this video is going to talk about a firm's supply curve, a firm in perfect competition in their supply curve. So this is a topic from Chapter 9. And in Chapter 9, we're talking about the competitive market, the competitive model, where our firms are price takers. So when a firm is a price taker, we know that price is equal to marginal revenue. They can sell as much as they want at the market price. So if we consider their marginal revenue curve, since their price is equal to marginal revenue, they can sell whatever quantity they want at the market price. Then when we go to graph their marginal revenue curve is going to be horizontal. It's going to be a horizontal line drawn in at the price. So if we were to say, if the price in this market were to be P1, how many units of this good would a firm want to supply? Well, that was a question we said, that was how we introduced the supply curve back in Chapter 3. Now we can answer that question a little bit differently. If the price of this market, if this firm faces a price of P1, how many units of this good would the firm want to sell? How many units would they want to sell to maximize profit? Because we've now introduced profit maximization as the goal of the firm. So if the price was P1, how many units of the good would this firm want to supply? Well, we would draw in a horizontal supply curve, or a horizontal marginal revenue curve, and I'll call it MR1 because if the price was P1, then this would be the marginal revenue curve that the firm would face if the price was P1. Now, I had an earlier video, and it talks in the book about the marginal cost equal marginal revenue rule for a firm to maximize profit. So we know that a firm wants to maximize profit needs to set marginal revenue equal to marginal cost. Well, here we have the marginal cost curve for the firm, and here we have the marginal revenue curve if the price was P1. So to maximize profit, we simply find where those two curves intersect. They intersect here. So if the price in the market happens to be P1, this firm, to maximize profit, would want to produce Q1 units of the good. Okay, I just picked the price P1 at random. We could set a different price in here. And suppose you said that the price in the market was P2 instead. And I've already drawn in a horizontal marginal revenue curve at that price. And so we have a horizontal marginal revenue curve. So again, if the price was P2, not P1, if it happened to be P2 instead, then we draw in a horizontal marginal revenue curve here, find the intersection of MR2 and the marginal cost curve that occurs here, and that would be Q2. That would be the quantity that would maximize profit if this firm faced a price of P2. And so that would be the quantity the firm would be interested or wanting to supply, because that would be the quantity that would maximize their profit. And then if the price was P3, then we draw in a horizontal marginal revenue curve. I've already done that, so that's MR3. Find the intersection of MR3 with the marginal cost curve, that's here. And then in this case, the firm would maximize profit by producing a quantity of MR3. I'm sorry, produce the quantity Q3, and then that would be maximizing profit when the price happens to be P3. And this is exactly, again, this is how we would have described the supply curve for a firm. We introduced that firm supply curve back in Chapter 3. We said the supply curve shows us how many units of a good the firm wants to supply at different different prices. And now we've been able to show, well, how does the firm, decide how much they want to produce? Well, they will choose to supply the quantity that's going to maximize their profit. Now, we can talk a little bit more about this, because at these different prices, we could see that a firm is not necessarily always making a profit. At a price of P1, the firm is producing Q1, and so their price per unit is P1, but their cost per unit, we'd have to go up to the average cost curve, and we can see that the average cost, the cost per unit is up here. And that would mean, since the cost per unit is greater than the price per unit, this firm would be making a loss. So one way we can look at this is that you can write the profit for a firm profit can be rewritten as price minus average cost. That quantity, that amount multiplied by the quantity. So one way to think about the price is to be able to, at any given quantity, when the firm's maximizing profit, look at the price and the cost per unit. When the cost per unit is greater than the price, then this number here is negative. And that means you'd have a negative profit. A negative profit is a loss. The firm would be making a loss if the price was P1, they'd be maximizing their profit at Q1, but they would be making a loss. At Q2, well, the price is just equal to the MR2 is drawn in here, and P2 is such that the marginal revenue is intersecting the marginal cost curve and the average cost curve here. So the price just happens to be just exactly equal to average cost. The firm would be making a zero profit at a price of P2. And then at P3, they'd be maximizing profit at Q3. We can see that the price is greater than the average cost here. So they'd be making a positive profit because P is greater than this average cost here. And the firm would be making a positive profit. Now, in Chapter 8, we introduced the idea of economic versus accounting costs, and therefore economic versus accounting profits. In this chapter, when we're talking about costs, we're assuming that we have economic costs here. So if a firm is making a zero economic profit, that actually turns out to be like a normal or an average accounting profit. So a firm isn't actually making no money here, but they're making what we would consider to be an average profit, because what we'll assume is that people have invested some of their financial capital, some of their money in this firm. They could have invested it elsewhere in the economy. What kind of return could they have gotten if they invested elsewhere? Well, we'll assume like the average return, because you can't systematically do better. Everybody can't do better than the average. So what we will consider is that the average return that you could get out there and investing in a lot of different companies would be sort of the relevant opportunity cost. So zero economic profit is actually sort of like a normal or average rate of profit. So that's like a normal return on investment. A positive economic profit, like you would have at P3, is actually a very, very good thing. And then at P1, we've got an economic loss. It might be an accounting loss. It might be the case where it's a positive accounting profit, but such a small profit that we would consider from an economic standpoint to be a loss. One thing that we're going to see is that in the long run, a firm is not going to want to continue to operate if they're making a loss. So when we think about the supply curve here, the marginal cost curve, if it's the short run, the marginal cost curve is going to be the supply curve for the firm. If it's the long run, then this marginal cost curve is only the supply curve if we're at a price where the firm's going to actually make money, going to make at least a zero economic profit. But in any event, the important takeaway from this is to remember the marginal cost curve for the firm ends up being its supply curve. If it's in the long run, then it's only the part of the marginal cost curve that's going to be above the price, this price here, where they would make a zero profit. If it's in the short run, then the marginal cost curve continues down here. There's a proviso for this. They talk about it in the book. I'm not going to belabor it here in this video, but there is a point at which in the short run, a firm is going to want to shut down. There is something called a shutdown point. That's a relatively, that's a little more advanced or a little more nuanced. So the important thing to really remember is that the marginal cost curve ends up serving as the firm's supply curve. And what we've really done here by looking in Chapter 9 is we've given us a better perspective on where the supply curve from Chapter 3 that we introduced first in Chapter 3 comes from. So This is how a firm's going to maximize profit, and then therefore how their marginal cost curve ends up being their supply curve.